This conversation today is with Brooker Belcourt, the CEO of Covey. Covey is a platform hosting analysts ranging from hobbyists to traditional finance industry veterans and everyone in between. Effectively, they're bringing a ton of analysts together and then allowing you to see who performs the best. The company has raised $2.5 million, and Brooker has the perfect background to be doing what he's doing, having been and worked with analysts for many years. I think this is a super exciting young startup and definitely one to pay attention to. Something if you believe in the concept of an analyst as a method to determine what is the best strategy for my portfolio. And an analyst takes different approaches. And we talked about the different approaches that they take. Some are very specific in a niche, some are high level macro, some are quantitative, and Brooker breaks it down for us. So I hope you enjoy this conversation. Here is Brooker Belcourt. All right, Brooker, excited to chat with you. I was checking out Covey. I love what you're creating here, and it seems like it's been your life path here. It's certainly an exciting area to be in. For myself and people listening, can you articulate what the initial vision was behind Covey and how you sort of see things going forward?
Yeah, well, first, I'm really happy to be here. I love the content you're putting out. So happy to be a part of it. So the why for Covey is we don't really know who the next great investment analyst is. We have no infrastructure to find them. And it's really a disservice to all of us that we don't know who that next great investment analyst is, because if we did, we could allocate our money to them and we could all benefit. And so Covey is a community to find and reward the next great investment analysts so that we can all copy their portfolio and attain greater wealth as a result.
And then structurally, how did you set this up? So what's the sort of underlying mechanics of how it works?
Yeah, so anyone can join. It's totally open. You join and you create a virtual portfolio of stocks, cryptocurrencies, even ETFs. So you enter them like Facebook 10%, Ethereum 10%, totally virtual, totally free. And you build that. And then we start tracking your metrics in real time. We have like 50 metrics, hedge fund level stuff that we track every 5 minutes. And we record all that for you, give you a shareable link. And then at the end of the month, we reward the best investment analysts. And, we hope to find the top 1%, and we hope to allocate money to them.
So what does that mean? So if you reward the top analysts, does that mean they get some fixed percentage of somebody's, like, how does the actual money flow?
Yeah, it's a great question. So in the beginning, we've been doing this for about a year. And so for the last year, we've been rewarding analysts in other people's tokens. So we were giving away basically cash in the form of tokens to the top performing analysts. And what we're doing right now is we're saying, hey, this community has created a ton of value and they really own this database of ideas. And so we want to reward them in our own token so that we can somehow transfer the value of this community back to the people who contributed all the data. So we're switching, actually, we're in the progress of doing this right now to launching our own native token. And so if you join Covey now, you'll start earning our own native token and you'll be able to have some ownership in this community.
So the introduction of the token is primarily to incentivize people to, how would you quantify the primary incentive of the token?
Yeah, I'd say it comes down to 3 things. So first, the token allows people to have governance of the community. So controlling how the future rewards are distributed, right? We have to come together as a community to decide who is the next great investment analyst. So we have this thing called the alpha algorithm, which we should definitely talk about. And that is our way of finding the next great analyst. So it's governance over that. And then number 2, it's staking. And so in order to earn tokens on Covey, you have to stake tokens. And the reason we do that is because we launched early on and a lot of people were just joining Covey. It's totally free to join. And so we needed a way to be able to block the spam. So someone showing up, creating 1,000 accounts and one of those accounts doing really well, we needed a way to block that. So staking allows us to block that. And it also gives analysts a bit of a confidence interval. So it allows you to distinguish who's really confident about their bets. So staking is another one. And then the third benefit, which we'll be launching in 2023, is any sort of monetization that happens from the platform. We hope to transfer some of that value back to the people who contributed the data. So the first one we'll see is we'll be launching a copy trading app in 2023 that copies the best analysts on Covey, and token holders will be able to get discounts on that product, similar to how like Binance or FTX offers discounts on trading fees to token holders.
Interesting. Okay. So it's not necessarily foundational to the user experience that you can have. I mean, it is now operating without a token, and the token comes on and solves governance for product development, the staking to eliminate duplicate accounts, and then incentives for future premium user experiences.
Yeah, it would be hard to do it without the token. The token is our way of saying, hey, everyone, you're contributing data to this community. It's super valuable. We want to give that value back to you. It's sort of taking us from the Web 2 world and saying, hey, we can actually give data or give value back to these contributors. And that's how we're doing it as the token.
Got it. What have you thought about, or what is I would think intuitively that if somebody were to build a portfolio, have a macro thesis, or be investing in some area they have some undifferentiated advantage in, or they've studied and observed something, that's the value that an analyst would bring, I would think that the one revenue model would be people can invest in this person, and then this person gets a percentage of the rewards that, that they manage. So typical like capital allocator, whether it's a VC fund that gets a percentage of what they carry, or like an equities trader, a fund manager would typically have like a percentage fee that they take for the amount of money they manage. Is that interesting to you? Do you feel like that's flawed in a way, or what's the advantage of the model you set up in contrast to that model?
So you're saying basically allow like others to almost stake on an analyst and participate in the rewards that they get. I think that's a really cool concept. I think that's something that's also that, there are a lot of people who are contributing to the discovery of talent, and those people should be rewarded in some way. And so we're actually building tools to allow others to stake on our analysts to participate in rewards. It introduces a lot of like complicated dynamics, right? Because, well, how much of those rewards should they be getting, the people who are staking on an analyst versus the analysts themselves coming up with the ideas? And so we're talking with our community about how to do that. But I love that idea. And the other way, switching your point to another side is, well, Covey is a great tool that allows anyone to credentialize themselves, to say, hey, I'm the best analyst on Covey. Look at me. Because if you're the best analyst on Twitter, no one really knows who you are and no one trusts it. If you're the best analyst in Fidelity, you don't know who that person is, or the best analyst on Robinhood, that's totally lost. And so with Covey, you can credentialize yourselves, and we hope that there are going to be asset allocators coming to look at Covey, and we're having those conversations now to say, hey, come check out this amazing talent on Covey and help them get seeded and help them grow a fund, because it's really expensive to launch a hedge fund, like $300,000. Not anyone can do that. And so hopefully we'll bring those people in other ways to be able to help in this talent discovery.
And is there an initial revenue model, or do you look at the tokens as part of that, or what you just mentioned too as well, the hedge fund? Or is that moving into the revenue model, and then early days is like freemium, figure it out, get people to use it, build a community?
Yeah. So our revenue model is going to be off of the copy trading app. So we're going to introduce an app in 2023. We're building it now, which will allow anyone to participate in the ideas of the best, the top 1% of analysts on Covey. And that strategy, we've been testing it ever since we built the company. We love that strategy. The top 1% of analysts on Covey are up like 20% this year in a down market. it's a really effective strategy, and we want to give that to others. And so now you can go to Covey and you can see our top analysts. You can manually enter the trades in your brokerage account. Definitely a bit of a pain. You have to do a lot of work yourself to get those rewards of the upside of performance. So what we're going to do is we're just going to package that in an app and do all the work for you and charge a very low fee to be able to do that. And that's how Covey will make money. And we'll obviously return value back to our community that contributed the data, because it doesn't exist without them.
So, okay, so is the app foundational to the experience of is it like mechanically, is that working where people have a crypto wallet and they move that wallet into a Covey account that's held custody managed by Covey, and then Covey is making trades from the crypto account into the analyst's portfolio? I'm kind of just riffing here what I'm imagining.
Yeah.
How is this working?
Yeah, I love the way you're taking it. You're deep in the crypto world and you're thinking about all these cool things that you can do with the crypto tech. Our first version is going to be super, super simple. It's basically going to be an app. You download it, you deposit money by connecting your bank account, deposit $1,000 and pick a strategy, top 1% of analyst ideas, and then we just invest it. So really, really simple. Long term, we could do some sort of thing with custody and crypto, and I think that would be awesome.
Okay.
But it's just going to be deposit money and then follow our top analysts' virtual portfolios that are on Covey.
And these are analysts investing in public stocks, not crypto.
Yeah. So our analysts
okay.
in equities, ETFs, and cryptocurrency. So you get everything from them.
Got it. Okay. So in the beginning, it wouldn't encompass the crypto, just be you give them $1,000, connect to your account, and then that gets issued into you get an allocation of their portfolio based like the right diversity of their.
You would copy their portfolio and you would have your own investment account, and it would be isolated. So the manager could never actually run off with the money. They never actually touch the money. So it's all done through your own account that you set up on Covey. And you will get access to the crypto exposure as well. We found a way to solve for that too, which is great.
Okay, got it. You get access to the crypto exposure, and that would be through another player where it's like, hey, I want 20% in Bitcoin, 10% in Ethereum, Solana, whatever. That would be that $1,000 comes in through the bank account. Does that get then sent to an exchange, or is there some company out there that handles this automatically?
Yeah, so there's a great company. Actually, our VC investors are also investors in it. There's a company called Alpaca Markets, which is awesome. Think of it as like the backbone of Robinhood. And so if Robinhood was a front end, you could just use Alpaca to connect you to crypto, to connect you to US equities, and it does all the trades for you. So it's really great software.
That is cool. Got it. That really makes this possible. So you think about it like, let's build a community. This is, I would imagine what Alpaca must have been imagining who uses this, because it's like, ultimately, I think of what you're doing from the most abstract level is filtering through to get the most accurate, truthful, sophisticated investors, like the best analysts, you could say, that most accurately predict the trends in the world. Is that kind of like, how do you think of what analysts are doing if you're described what they're actually thinking and trying to accomplish?
Yeah, we should definitely spend time on this. There's a lot of stuff happening. So with analysts, just to give you a little context, what we've found on Covey and what we found looking at different research, that the great analysts tend to stay great. And we know this anecdotally. We love Warren Buffett in 2022 because he's done great in 2021 and years before that as well. And so we think that because he's done so well in the past, he's going to do great. And we think about this with a lot of other great investors like Ray Dalio. And so that anecdotally works, but also we see it in the data. So we see it on Covey. We see that the top 10% of analysts generally stay in the top 10%. There's very, very little turnover. in that top 10%, like almost half of them just stay there month in, month out. So super sticky at the top. And in academic research, this phenomenon is called performance persistence. And it's been observed at retail investors, mutual funds, and it's just stickiness at the top. So these great investors tend to stay great. And then in terms of like what you're asking about, well, what are these people thinking about? What makes them great? It's really hard to say. I'd say their investment styles lean more fundamental, and they have totally different backgrounds. They're from all over the world. They're definitely not from Ivy Leagues and investment banks, which is where currently we go and try to find the next great investment analysts. And so they're from varied backgrounds. What they share is a passion for investing. They're on all over Twitter, on Twit, and they're on Reddit. They love this stuff and they live and breathe it. And so that's the only common denominator.
Interesting. And do you feel that the analysts I would imagine that there's different niches within the analyst world that you can observe a company based on maybe its individual fundamental performance. Like you can, take a quantitative or qualitative assessment. Like, hey, I really like the CEO. He's super motivating. You could almost give that bias towards the company. Like in a sense, they're worth more. Upside is higher because the CEO is inspiring. People want to go work for them. You could say, okay, all the, alpha, beta, like I'm crunching the numbers, and then quantitatively, this looks like the right company. Macro perspective. What are the analysts? Do the analysts generally fall into these categories? And are these categories competitive, or does one tend to win out?
It's fascinating. I would say with Covey, what happens first is they develop this track record and they rise to the top of the leaderboard. And then these stories start to be developed about how they got there and what their strategy is. And you'll see their profiles become much more intensive about, their quant model or their short model and how they think about stocks. And I think that's also true in the markets. When you look at some of the best investors, they start to do really well. They have the strategy, and think about Ray Dalio. He's got the strategy, he's doing it. And then he starts publishing all these ways about how he got there. And then we start to get really into it. Same thing with Warren Buffett. He's had this investing style of value investing. People get enamored with it. No one really heard about it. Now they're enamored with it because this track record is so amazing. Who knows if that strategy even works anymore? It's probably gone. And then we build this story around it all. So I think that's also going to be the case with Covey. Is these people are testing out strategies, trying to figure it all out, and then they're going to craft a story later about how they got there. But investing is so much about trial and error, and Covey gives you this chance without risking real money to figure out your strategies, figure out how to actually make money in the market.
Interesting. And is there an effect to be aware of where people fall into luck? Like if you're playing the slot machine, eventually you're going to hit it. And then if people obsess about that time, or maybe over the last 12 months, a particular analyst strategy looks great, but maybe there's a bias there. Like I would imagine cognitive biases must be, I don't know if it's, I haven't gone down the finance path, like professionally, but I would imagine having friends that have like bias has got to be super prevalent in how you're thinking. Past success bias. Yeah. Is that talked about a lot?
We should probably talk about it more. I would say, well, back to that performance persistence thing, is there's this barbell in Covey where the top 10% are really, really sticky. And unfortunately, the bottom 10% are also really sticky. And then in between, it's really random. And so in between, you get those runs where it's, hey, in this month, that person who's been long crypto all the time does incredibly well. And then they're out of the leaderboard for the next few months as crypto does poorly. Whereas in the top 10%, they were in crypto in 2021, then early 2022, they went big into energy. And then they now are shifting into these growth stocks that have been so beaten down that are now ripping. And so you see them constantly changing. And that's what makes them so sticky, is they can adapt into all these different markets.
Interesting. And do you feel like these people is it typically a framework, either that currently is emerging or that you suspect would emerge? Like, okay, so you're effectively taking the decision-making process on analyzing stocks, equities, funds, crypto, and you're making it super, super transparent and public and liquid. So when that happens, generally the best rises to the top the fastest. And you also get an acceleration of what the best is, an increase in the best. So like the internet comes on board, the creativity of people is the potential for creativity is facilitated by the connections of the internet. And then I think of in the analyst world, okay, we have an objective. It's to increase the value of our portfolio. And effectively, it's give money, allocate resources to projects that have the biggest upside. And that might be commodities, it might not be a project, but it's how do we anticipate value increasing or decreasing in the future and then invest accordingly. It's a form of fortune telling. I mean, it's a form of predicting the future, really, but it's necessary to do. Like I'm trying to make sense of it. I'm trying to think like, what are the patterns in analysts? Are they, like why would someone be good repetitively? What do they have insider information? Are people's brains susceptible to gaining a bigger picture of the world? Like some people intuitively have an advantage over other people?
Yeah, I think it's definitely the best analysts do tend to have some sort of a process. And so my background is I've been working at hedge funds before Covey for the last 7 or so years. And most recently I was at Citadel. Before that, I was at a Tiger Management Cub, which is like a big hedge fund complex. And before that, I was at Coatue. And what I noticed over that period is first, any person who wants to put money into a hedge fund, they always ask, do you have a process? Do you have a process? They want something that's repeatable. And I would say that each of the PMs or the firms I worked at, they definitely had a style that stayed the same. When I looked at Coatue, at Philippe Lafont, he's running 20, 30 or so billion hedge fund, one of the most successful tech hedge funds. And he had this style where he would invest in huge addressable markets that are pretty obvious, right? Stuff like streaming or access to fast internet. And he would pick the number one player in that market and invest in it. So if it was streaming, buy Netflix. If it was payments, buy Visa. If it was fast internet, buy Equinix, which is an enabler of really fast internet. And he had this thesis and he just kept doing it into different markets. And he would have to get really good data to be able to do that. But it was a process that was repeatable and it wasn't that complicated. And at Citadel, I observed something similar as well. There was trying to get all analysts to get into this process where we would look at quarterly reports and we would try to come up with a process of predicting what was going to happen after the quarterly results. And we would combine data with management conversations and try to predict that and develop a process so we could get a hit rate above 50%. And so it's all about developing this process. And I do tend to see a lot of the top analysts on Covey have some sort of a thesis or process that they do tend to stick with. And we're learning more about them. We've only been around a year or so, and we're learning more about them and seeing who the top analysts are and how sticky they are. And we're actually working on doing a little bit of a profile piece on all of them so that people can learn more about their processes.
It's interesting. And do you feel like that in the hedge fund world, we've largely surfaced the best ideas, or do you feel like there's a lot of untapped potential to analyze the world in a better way?
Oh, I think there's so much untapped potential. I think that we've learned that in this whole Reddit phenomenon and Wall Street bets and FinTwits and all these apps that have popularized investing, we've learned that there are these amazing analysts that are not working at institutions, not working on Wall Street. And they have these ideas that are totally differentiated, that are not being deployed by Wall Street. And so Covey's goal is to go and find these people because there's no infrastructure to find them. And I think there's an amazing talent and amazing alpha left to be able to discover. And it's a huge realm where we can create almost a new mutual fund complex that beats the old mutual funds that you and I would probably never put any money into, because we just don't trust the institutions that run these mutual funds like JP Morgan and Wells Fargo.
And the people who would be the analysts themselves, I'd imagine like table stakes would be, you have to be full-time if you're going to be one of the best. This can't be a part-time thing that you just throw up there like a lottery ticket. There's probably a identifiable, repeatable process, and there's some uniqueness to the process. If you don't have any one of those, you're probably not going to be a top analyst. Are there other things you anticipate that will separate the top analysts from the rest?
I think, to be fair, I think the 2 out of the 3 things you said really matter. I would say, I don't think you necessarily need it to be a full-time job right now. I think just like a lot of the tech startups, these things start as these side hustles for people. Covey is probably a side hustle for a lot of people right now. And then they see that they're doing really well, and it turns into more of a full-time job. And so I think that part is we're really going to appeal to the side hustle, and hopefully it will be a full-time job for people later on. In terms of the other trade, you really need to be passionate about investing. There's a big group of us that we wake up, we check out stocks in the foreign markets. 9:30 is a ritual every Monday through Friday where we check the market open. 4 p.m. we're thinking about it. And we just love this thing. Love chatting stocks, that annoying person at the dinner party that just wants to talk about crypto or stocks. And that's definitely a personality trait that you almost need to be addicted to it. And a lot of our analysts love this stuff and could chat your ear off. And we have a Discord server where we chat about ideas. So that's the other trait that I'd say you have to have.
Yeah. What type of personality trait do you think is most commonly like in a successful analyst? Is it like, I can't imagine that most people are deeply motivated. Like making money is certainly got to be a motivation. It's like the reason you play the game, but it's not really the motivating, engaging, thing. Cause there's some people who have made more money than they can spend. Like Warren Buffett, it's not about the money at a certain point. How do you think of the different motivational factors or like personality types of people that, maybe people are sitting there thinking like, oh, I'm really interested in the market. Maybe this is my calling, and then they should feed it more. Like, how would you, if you were to talk to a young person or anybody, how do you sort of think of like, identify who these people are?
It's really tricky to say. I think for me, what it is in life, it's so hard to find like these absolute truths, things that are like definitely true. And so when you think about what investing is it's coming together with all this different research that you put together and then placing a bet and saying, I believe that this is going to happen. I believe that everyone's going to start using TikTok and Facebook is going to fail as a result. And it's so rare in life where you can actually come up with an idea and place a bet and then be proved right or wrong with pretty definitive certainty. The market will ultimately be the truth teller. And so I think it's people who are really attracted to that process and testing their assumptions and really putting themselves out there and making a bet. That's one personality trait. And then another one that we see is just the classic analyst simply doubts everything. They don't believe anything, and they doubt everything, and they think everything's BS, and they try to question it all and hopefully be proven wrong.
That's interesting. Yeah, I really liked what you said there about the truth. Like it is, there's an absolutism to the market. Like the Bitcoin price there's just one price. Yeah, sure. It may vary like in some small degree by exchange, but really that's just noise on the pricing indicator. And it's also kind of differentiated, I think, from gambling. Like in gambling, you have similar mechanics, right? You're trying to predict the future. You make some sort of educated bet, and there's a quantifiable outcome that's correlated to like your monetary returns. But the sophistication of betting is shallow. Like it's not, and it's not influential. So it's both not sophisticated and largely like the complexity of it. It's like, okay, I'm going to make a bet with you, or I'm going to buy a lottery ticket or pull a slot machine or roll a dice on the table. But ultimately, like the inputs to that are pretty limited. Like I can only pick red or black or pull this thing. And so I think sports betting gets more engaging. Like I've listened to some podcasts by sports bettors who have like a system, like they're more close to market analysts than I think than just people buying lottery tickets. But there's something similar along that same vein.
Yeah, it's one of the few places in this world where you can come up with a thesis and actually find out if your thesis is right and profit from it. But I think, as you're saying before, it's not necessarily the profit. It's just putting yourself out there and believing in something and then seeing if it turns out to be true. That's the part that I love.
Yeah. And well, I want to talk about that for a second. So we have truth, right? Is the market is undeniably the price that it is. And like I said, there's some buy sell slippage there, but there's often, I find that I'm fascinated by the biases that people have on like a collective level. I think in crypto especially, there's an assumption that DAOs or community-based voting surfaces the best ideas. And maybe that's like an inherited Western idea of democracy inherited up, or maybe it's a fear of centralization. But I feel that that's, in a way, there's a blind spot there where like the herd mentality can be wrong. Like everyone can be wrong on something. And I see that sometimes happening in the markets. And I would think of analysts as like, they're the ones independently thinking, and they're the ones keeping the market from going off the rails or from believing something that's not true and moving us all in the wrong direction. Do you see any like consistently played out biases in the market that you think that most people don't appreciate?
Oh, that's definitely a tricky question. I think over long periods of time, the market is definitely true. And so there are, over shorter periods of times, there are these like boom and bust cycles, which tend to happen. And it's pushing up on fear and greed. And you can see that most recently in 2021 with the loose monetary policy, everyone got overextended, and then it pulled right back in. And so the market definitely goes through these swings. But the one thing that I would observe just from my experience at hedge funds is when you look at the way people model companies like Google, Facebook, and Amazon, the consistent thing I noticed was people always assumes that revenue will decelerate fairly quickly for large companies like Amazon and Google. And so they see the revenue growth of 40% this quarter. Then next quarter, it's 39%. The quarter after that, 38, 35, 36, and it slowly decelerates. And they become more short-term sighted. And what actually happens is if you look at the models for Amazon and Google, is that revenue like rarely does decelerate. And when these companies are doing something extraordinarily well, they can attain incredible revenue growth over long periods of times. And so consistently analysts model deceleration, and that with these amazing companies does not turn out to be true. And so I think it's that old premise that we get really excited about something happening really fast and it doesn't happen. But then if you wait 5 years, it happens like way bigger than we actually thought it would ever be. So like we overestimate the short term and we underestimate the long term. I think it's that thesis. Bill Gates was quoted that, and you see that in analyst models for investing. Yeah,
that's fascinating. Yeah, why is that? We underestimate the short term, underestimate the long term, overestimate the short term. We want, I think of it from first principles perspective. We want the most and the least amount of work. So if we're seeing that happen, there's like a positive feedback loop that can be exploited when, if you think of them like resources, sometimes I like to think in real simple natural terms. So it's like if we stumbled upon a ton of fruit, like all of a sudden we're walking in small tribes, like prehistory days, humans discover all this abundant fruit. and maybe they index on that being the standard. So it's like, oh, we discovered this, so that will continue to be the way it is, or there'll be even more if we keep going. And it just seems like such a deeply encoded part of like life. Like, do you view that as a flaw? Do you view it as a judgment flaw that is across many, many, many different people that we get these boom and bust cycles? Or on the flip side, do you view it as like, yeah, this is a good thing. This is the ideal way markets should grow?
I think it's just really hard to think long term and to understand how compounding works. And there's Warren Buffett will say this all the time, that like the most misunderstood thing is compounding. And it's just like for our brains to understand what something growing at 10% over long periods of times look like, it's so hard to capture that in our own head. And we're really good at figuring everything out on the short term. It's just so hard to think about things long term. And a lot of the greats like Warren Buffett can look at Coca-Cola in the 90s and the early 2000s and say, okay, this thing can still keep growing at 10%. Whereas a lot of us will be like, oh, everyone drinks Coke, it's over. There's no point in investing in this thing. But the thing just keeps chugging along because he understands compounding and what that looks like over long periods of time. And so it's just so hard for us to think 10 years out and to, for example, for cryptocurrency, to think 10 years out and think about all the implications of what Ethereum could be like, what Bitcoin could be like 10 years out, and wait that long and just sit and put it aside and hopefully not think about it as much and what will happen is you'll see that the usage growth will slowly start compounding. And you start with 1 million users on Ethereum. And if that's growing 20, 30% every year, that's going to be a huge number and over a period of 10 years. And it's just so hard for us to fathom that and have the patience to wait for it.
Yeah. Yeah. And do you feel on crypto that it will largely supersede the existing financial layer we have now? Or how do you see crypto emerging in the like 5 to 10 year spectrum?
Well, I am incredibly bullish on crypto, and I love listening to your podcast and hearing all about the different founders working in crypto that you interview. It's awesome. So I am incredibly biased. Definitely the wrong one to ask, because my answer will be that over a long period of time, over our lifetime, in my lifetime, I believe that crypto will slowly take away at a lot of the things that traditional finance does, and it will replace them with much cheaper, faster services. And so it will take a really long period of time. I believe that it will be one of the biggest trends over my life. And so that's why I'm working in this space. But over time, they will slowly take away. It is simply a better service. Just look at the markets. In the US, the markets are open 5 days a week for 6.5 hours a day. The crypto markets are open 24 hours. Like that advantage alone, it should be enough to start migrating people over to it. The settlement time in the equities markets are 3 days sometimes. In crypto, it's done in minutes. Like these advantages will slowly draw people over, and the transactions are now getting cheaper. And so slowly it's going to chip away, and you're going to see it happen, but it's going to take an incredibly long time, right? If you thought that e-commerce was going to be the next big thing in the 90s and you invested in Amazon when it was 0% basically e-commerce penetration, you would have thought, wow, maybe it could get to 5%. Today, I think we're at 20 or 30%, and that's taken 20 years. That's e-commerce, and it's so obvious the benefits of it now, but it's still only around 30%. It's for crypto to creep into traditional finance. Like if it gets to the same growth rate of e-commerce, that means that we could take 20 years to creep into that much of a penetration, of a 20 to 30% penetration. I see what'll go along that. So this is going to take a very long time, but there's going to be huge growth for a lot of players in the space.
That's an interesting comparison. Do you feel like, is it, to be specific too, is it 30% of all e-commerce transactions are on Amazon now?
Well, I don't think Amazon is having all of them, but definitely check it out on your own. But I think 30% is just the broad e-commerce sector.
Oh, got it. So 30% of all, yeah, I'm sure we could Google this, but the rough sounds about right. 30% of all transactions are in e-commerce. Probably more spiked during COVID.
Yeah, I think it spiked up in COVID, but now it's back to the normal growth rate.
Either way, it's huge, but still comparable to offline. And at a certain level, like offline just makes way more sense, if you're buying food or something. But yeah, Amazon, the clouds, like I sort of think of it like Amazon has just taken all physical products and just made them a click away. And so easy to do. And if you explain that to someone 20 years ago, they probably agree that you could map it out and say, well, you have all these logistical lines, you have all the products that are centralized in warehouses, you have distribution trucks that run 7 days a week. It all like payment processing is stored on the app. Like it's not, in a way, the simple versions, the simple aspects of what Amazon is doing is not complex to explain, hard to do in the back end. I could say build a warehouse, but obviously that requires a lot of work. And you could use predictive analytics to say, and artificial intelligence maybe, but I like predictive analytics better, to say, okay, these are the products we expect that will be purchased in the city. So, it just has a structural advantage to it and an orders of magnitude efficiency advantage. Crypto, how do you compare? Do you feel like that crypto is the same order of magnitude advantage over the traditional finance space as e-commerce was to traditional commerce, or do you feel like it's orders of magnitude?
Great question. So if you think about the brilliance of what Jeff Bezos did, is he saw that over time, things were going to be bought online, right? And so the way he thought about it is, well, what is the sector that I can start with that is so obviously better online? And he didn't go to groceries, right? That's really hard. These things are super perishable. He'd have to have a warehouse that has a freezer section in it. He'd have to have a delivery truck that needs to get it there super fast. It'd have to be custom. He didn't start there. He didn't start with couches that are huge and really hard to move in. He started with books. They never perish. You can stick them in your warehouse forever. There is a huge breadth of supply. There's so many different types of books. So you can really compete with the booksellers who are only able to store so many amounts of books. And so he chose books as the first one and managed to build from there a huge empire that now, 20 years later, is now really starting to get into grocery. And I think the founder, and I know you have a lot of potential founders or existing founders listening, I think the person who's really going to solve crypto is the one who finds out, like, what are the books for traditional finance that I can bring into the crypto world and have something that's so fundamentally better that can drive people to switch over. And once they figure that out, it'll slowly go after the next industry, right? Think about online travel, how that went so quickly over. And it's all of these little industries, these little pockets of traditional finance are going to get chipped away at. And over time, it will take it. But I think the share of crypto transactions will be very varied across different sectors. And for me, I've picked data as an area that will move towards crypto much quicker than other datas. And we can talk about why I believe that's kind of like the books of the crypto world. But there's
tell me.
For debate. Yeah, so I think there's this problem out there where a lot of Web2 companies are saying, give us all your data and we're going to go and monetize it. And we'll give you a free experience, but we're not going to give you back any of that money. You're crazy. Like, we're not going to share this with you. And I think that worked fine for a while. And now I think people are waking up and saying, hey, you have a lot of our data. I want some sort of value of that. You need to start giving it back. And so Facebook is doing new things where they're starting to give, $1 billion to creators. YouTube is sharing their revenue 55% or so with their creators. And so more money is starting to go back. And I think that a lot of this data that we contribute, I think is one of those things where it's like data is the next oil. You heard that all the time. And so how do we actually price data is going to be a crucial thing in this whole equation of returning value back to the people who contribute data. We need to come up with a price of that data. And the token is an amazing thing for that. So you come to websites like Covey, and Covey, you give us data, which is your trade ideas. Trade ideas are a very, very small string of data, super, super tiny, right? It's just Facebook 10%, Google 10%, Amazon 10%, and you give us that string of data. That's incredibly valuable, especially if you're a really good stock picker. And then we save that data for you, and then we try to monetize that data. And exchange, if you do well on Covey, we give you tokens for your data. So you're giving us data, we're giving you tokens. The tokens are kind of our promise to say, hey, we know there's value for this, and we're going to return that back to you. And I think that model of exchanging data for tokens is an incredible model. And the cool part of what it will do is, I don't know what the price of an idea is. And it's really, really hard, and this probably will require a big market to start pricing these ideas. So as our token becomes more liquid, it will start to price the idea of a trade from a successful analyst. And so then you'll have an ability for people to go in and buy ideas from others using tokens. And so that's kind of our bet. And I can see that being applied to a lot of other industries.
It's cool. I like it a lot. Good description. Brooker, where are there certain books or people that you've learned a lot from or the most from over your path, your journey?
Yeah, definitely. I love reading books. I read a lot of history books.
Do you?
Books that I'm reading these days, my favorite ones that I got from Coatue, from Philippe Lafont, also one of his favorite books, is Engines That Move Markets. That's an awesome book. We talked a lot about how these trends appear super, we get super excited in the short term, and then we lose track of what's happening in the long term. Engines That Move Markets describes all the big trends over the last 150 years, railroads, canals, the internet, obviously, like radio, and goes through like actual articles from that time period and shows how people were so pessimistic about all these big trends. And it's fascinating to hear the Luddites and all these big trends. There's always haters. And so it's fascinating to hear that and compare it to all the haters of crypto these days. That's a great book. And then, these days I read a book, Price Wars. That's awesome. There's huge inflation in the food markets, and that has an incredibly negative impact to poorer countries where food is a much higher percentage of their income. And what it talks about is what can happen in those countries after a huge inflationary period of food prices, which is what we're going through now. And it talks about all the chaos that will ensue. And so that's fascinating on the investing side. And then just one of my favorite books is Non-Zero. It's a great book, one of those directions of humanity type books. Yeah, those are my top three. I don't read that many business books.
It's a good ones. Those are good ones. I'm really interested to check those out. Engines That Move Markets, Price Wars, and Non-Zero. Brooker, are you writing, tweeting, anything you want to throw out personally?
Yeah, I am all over Covey. I talk a lot about all the stuff that we're doing at Covey. It's a big project we're on. We're building a community to find and reward the best analysts so that we can all benefit. And it truly will take an entire community. So check it out at covey.io. We're also on Twitter at covey_io. We write a lot about what we're doing and share that on our website and on our Twitter.
We'll have all those links too in the show notes, but how about you? Are you writing or are you tweeting personally?
I write and tweet all about Covey under the banner of Covey. So
okay.
Everything I write is through there, and it takes up all my time. There's no like personal accounts. It's pretty much everything I do is Covey these days.
Nice. Congrats on all the progress, man. And hope to have you back on one day. I appreciate you coming on.
Yeah, thanks so much for the time. You have great questions.
All right, buddy. See ya.